That Cyber Monday week coupon code expires tomorrow night. Check it out in the links down below and get lifetime access to the programs on building your wealth before the price goes up. Hey everyone, me Kevin here. In this video, we're going to talk about two catalysts that we have to be aware of that are unfolding tomorrow. That's Friday, December 3rd. This catalyst shift tomorrow will be an indicator as to whether or not we should continue to buy the dip, or we need to hold on with buying the dip, stick to cash a little bit longer because things are going to get worse before they get better. Remember, I've been selling stocks for the last 3 weeks, waiting for this dip and catalyst opportunity. I did not know exactly what kind of catalyst we were going to be running up against, but now we've got a pretty good idea of the catalyst we're running up against. We know that we've got end of the year profit taking and a loss taking. We know that we've got the big ones, jobs and the budget deficit, government shutdown potential, which we're going to be talking about, expectations for that in just a moment. We know that we've got the FOMC meeting coming up in the middle of this month. We know we've got inflation data coming up on the 10th of this month. And we know that we've got some euphoria in specific sectors that has been expected to cool. We've seen software valuations start getting compressed, potentially under the fear that when rates go higher, software valuations will compress. Now, I will say I've been cheering for DocuSign to fall under 200. I was not expecting it to fall to 169 where it is right now. So I did a little bit of buy the dipping, and I might do a little bit more buy the dipping. But tomorrow might be a tell for me. Am I buying the dip too early, or are things going to get worse before they get better? Or am I performing just right, where I've spent about maybe 30, 35, 40% of the cash that I have, and I'm buying the dip, and I'm waiting for some of the other catalysts over the next week to play out, which honestly I expect a lot of them to be nothing burgers. But let me tell you exactly what to pay attention to for tomorrow. Keep in mind, the biggest goal that I have in this dip here is to buy more high growth, high margin companies. My favorite, most high conviction stocks for high growth and high margin, which I do think have the potential of selling down more, are Etsy, Roblox, SoFi, Enphase, Apple, Google, Tesla, although their net margin isn't super high yet. NVIDIA, chip play, metaverse play. And then outside of those, I'm also looking at Disney, PayPal, Matterport, and potentially a trade on some of the recovery stocks like Carnival Cruise Lines, although I'll be in that very briefly. Also looking for a recovery or some sort of rotation on financial services like Coinbase, Robinhood, which I do expect that we'll see. So, with that said, what do we need to pay attention to for tomorrow? Well, there are a couple things. The very first thing, you should write this down. The very first thing that you're going to be looking for tomorrow are payroll numbers. If we get a big beat here, well, there are a few ways we can go. Let me give you the numbers first, and then let's try to break this down. So first things first. Payroll expectations right now are that we will see 550,000 jobs. So write that number down, 550,000 jobs. If that number comes in way higher than expected at, say, 7, 8, 900,000, a million, that could potentially lead the market to sell down as individuals believe maybe the economy is indeed overheating and Jerome Powell does need to lower or raise interest rates to combat inflation. But it's not just going to be that top line number, because the bigger that top line number is, the more part one of the Federal Reserve's mandate is achieved, maximum employment, right? But then we also have price stability, and we also get a price stability tell tomorrow. We're expecting an annualized month-over-month rate. So you take the month-over-month rate, you multiply it by 12, not compounded. I've explained that before already on the channel. We just want to know what speed are we going at right now, not the distance we're traveling. We're expecting a speed of 0.4%. That is an inflation rate of about 4.8% annualized for wage growth. So the two big numbers you're going to look at tomorrow, top line number, if it's a lot higher than 550, could be a problem. If it's a miss, if it's anything below 550, that could actually be good because it might slow down the taper, lead more kind of cheap money to flow into the economy. So anything over 550, not so ideal. Anything over 0.4 on that wage calculation is going to be something that could potentially make the market a little bit more nervous, especially if we got a number like, let's say, 0.7, because 0.7 times 12 is an annualized inflation rate of 8.4% in wage growth. That's going to start creating nervousness and discussions for the next month about a wage price spiral. This would be a negative catalyst. So tomorrow, I think, is a really big potential inflection point for the market, where we're either going to see the market go, okay, all right, you know, things are good, things aren't overheating, but things are good. And as long as things are good, then hey, you know what? Buy the dip. That, I think, is what we're looking for. Otherwise, if we get bad news, the dip will keep dipping. Like, DocuSign's now at 166. Started filming this at 169, and that is a dip that keeps on dipping right now in the after hours. It is not good. It is after hours, so who knows? It could end up recovering tomorrow, or it won't. Remember, we've been talking about valuation compression for software companies on this channel for almost 3 weeks now. I've been warning that software companies are likely to see compressed earnings, and that's why I've been encouraging hardware companies with high margin, the Enphase, the Apple, the Tesla, the Nvidia. But anyway, not financial advice. I'm just the stock doctor. All right, so then we've got the next catalyst, the budget. All right, we need to talk about this. Mitch McConnell right now, at the time of this recording, is actually meeting with Joe Manchin. This is very, very rare. I expect that Joe Manchin and Mitch McConnell are talking about their strategy for whether or not that Build Back Better plan is ever actually going to get taken up in the Senate. But as they strategize on whether or not they're going to take up the Build Back Better plan, which I do expect they'll take up the Build Back Better plan at some point next year, because Joe Manchin could just roll and go, hey, that's fine, I'm fine with the Build Back Better plan. I expect that Mitch McConnell is a Republican, Joe Manchin's a Democrat. He's that key vote in the middle, right? I would expect that Mitch McConnell is asking Joe Manchin, hey, look, we're thinking about kicking the can down the road on the government shutdown. We're thinking about kicking the can down the road until February. Are you cool basically just holding out with us until February before dealing with the Build Back Better plan? Mitch McConnell would want that to happen because Mitch McConnell will then have his base and Democrats nervous about the election coming up in November. Campaigning season is spring and the summer, right before the fall election, and campaigning season starts right when that can's going to be getting kicked down the road for the 2022 election, which is going to make things probably tougher for getting the Build Back Better plan done. So I think Mitch McConnell's kind of looking for like, hey, we'll get you the vote on kicking the can down the road till February. We'll get Democrats to vote for this. The House is voting to pass the extension right now. We expect it to pass the House. We expect it to pass the Senate. But I believe that's what's happening here. Background negotiations about, hey, let's kick the can down the road. Let's just pick up Build Back Better in the budget in the springtime. Let's get through the holidays. Let's get through the vacation. In my opinion, that is actually going to, if this ends up happening in the next 24 hours here, 24 to 36 hours, and we end up averting a shutdown, that's going to be good news for the market. So you've kind of got this potential for double good news, bad news, or a mix. And CNBC will not stop talking about DocuSign plummeting, which please, fine. Keep talking about DocuSign plummeting. It's fine with me. I've been wanting to buy that company under $200 for a very long time. I'm kind of happy that it's on sale. I think we'll see where it bottoms out, but I might be adding to this one a little bit more. Okay, so here's the thing. What's very, very important right now is how these two things are going to play out. Again, if jobs numbers come out in our favor, buy the dip. If jobs numbers do not come in our favor, we could be in for more pain. A lot more pain. Then, flipping the script. If we end up getting a budget or government shutdown, that's going to lead to more uncertainty and nervousness. And that's not good. Oh yeah, look at this. As we move through Q3 and into the next quarter, and they just put the screen away, basically DocuSign saying they're seeing people's urgency to buy subscriptions for DocuSign waning, and those DocuSign subscriptions definitely slowing down, so at a slower pace, and that's why they're slowing guide. I think DocuSign's still a great company. You've got a COVID play inside there though, right? As COVID goes away, the whole stay-at-home thing goes away, we're gonna expect more COVID stay-at-home traders to actually get out of DocuSign and into other stocks. So that's what I expect to be happening here. But again, even at 160, it's still an expensive company. You're still paying probably somewhere around 40 times forward. Let me actually just look at the financial analysis again here. 40 to 50 times, might be closer to 50 times. So we're kind of combining this stream with, or this video here with multiple different updates, but that's fine. I think that's what y'all appreciate anyway. So we're looking at EPS of about 355 in 2025. Nice compounded annual growth between 25 to 43% expected. We are expecting profitability this year, which would be great. So that'll be a very big rotation for DocuSign. And a 355 on a 160 valuation for the stock. That's about a 45 forward PE. With the growth rate they have, it's not terrible. Not terrible at all. It's certainly between a 1 and a 2, depending on which year you're comparing to for growth. If you're comparing to 2025, compounded annual growth about 24, 25%. Let's go with 24. That's going to put you at a PEG ratio of about 1.8. Definitely on the expensive side, but boy, oh boy, that seems like a potential oversell right there. Down to 166 right now. Wouldn't be surprised if it keeps selling off the more CNBC keeps bagging on it. But that's okay. You buy the dip when there is blood in the streets. So, again, it might make sense to wait, though, until tomorrow morning to go crazy on DocuSign, specifically because of the catalysts that we have expiring tomorrow. So pay attention to those catalysts tomorrow. They're going to be big. We're going to get the jobs numbers coming in at 5:30 a.m. Pacific time, and that's 8:30 a.m. Eastern time. And the budget regarding whether or not we'll have a government shutdown or not, we should know within the next 36 hours on that one. I expect the Senate will pass something last minute tomorrow, and then we'll get the headlines, budget, government shutdown averted, blah, 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 blah. Anyway, bullish. I'm glad I raised a lot of cash because we're seeing a lot of pain, and I like shopping when there's pain. All right, folks, thank you so much for watching this video. We'll see you in the next one. Check out the program's link down below with that Cyber Monday week coupon code expiring tomorrow. All right, folks, thanks so much. Bye.